Hi, welcome to the channel. It's a series. My name is Sekwati Pizzo, and in this series we talk about the biblical investment, how to invest in a biblical way. The title of the podcast is Hope for Tomorrow, and we are continuing from our last episode. In our last episode, we spoke about all the options that are available for investment. You recall that we spoke about one, the savings, two, we also spoke about retail bonds, we spoke about tax-free investment, we spoke about ETFs, we spoke about retirement annuity or pension. We also spoke about the individual stocks. And in that, when we're talking about ETFs, we introduced ETFs as a better way of diversifying. You remember when you're talking about diversification, I quoted the Ecclesiastes chapter 11 verse 2, where Solomon speaks about investing in 7 or 9 ventures because you don't know what will happen in the land. And I'd like to thank those who watched the last video and send some comments. Please, if you like this, send comments, like the video, and in the comments, please send the message of what you like to see in the next video, or ask questions. Today I'll also be answering some of the questions that people send either privately or open in the open. And also, if you want us to keep in touch with you, please be on our mailing list. I think one of the things that, please like the video if you like it. Yes. So today we start with the minimum disclosure, which is a document that you get for each and every ETFs or unit trust. And I'm going to be, I'll show you the two contrasts I did, two of the ETFs, that one ETF and one unit trust. And I'm just going to show you on the screen, and as I show them on the screen, I'll be talking to you about them while they are on the screen. Remember when we spoke about ETFs. ETFs are exchange traded fund, and those are you can trade them at the stock exchange, and those ETFs or the exchange traded fund are very, very much diversified. And if you have one, you are investing literally in more than 10 companies. So it is a way of ensuring you diversify your holding, you diversify your investment portfolio. So in this, I'll be talking about, among others, two exchange traded fund, one ETF and one unit trust, which bear the same name. This is one of my favorite. I would say this is my number one favorite ETF, satrix MSCI World ETF. And there is also on the same a unit trust that has almost the same name, the satrix MSCI World Equity Index Feeder Fund. So they have almost the same kind of holdings. So the ETF, the fact sheet has, or the minimum disclosure, number one, it has your 10 holdings. And if you can see on the screen, I've circled them on red, and I've made them a red circle around them. It will tell you that the the top holdings. Number one, it has Apple, Microsoft, Amazon, Alphabet, Exxon, and all that. So already you know, if you buy this one ETF, you have Apple in your investment, you have Microsoft in your investment, in your portfolio, you have Amazon, you have Alphabet, you have Telsa, you have Johnson & Johnson. And then if you check on the other screen where it is a feeder fund, which is a unit trust, you have almost the same, but the percentage are not the same, are not exactly the same. The one would have, the ETF would have probably in this one, the ETF on Apple has 4.18%, and then on the feeder fund it has 4.18, and on the ETF it has 4.32. So as you just see that, so you know that the fund managers had time to look at this, and the difference among sometimes would be on your feeder fund they have included something, the iShare Core MSC World, they have included the other fund within the fund. That is why they call it a feeder fund, because it's a fund within a fund. And the second thing that you have on your facts sheet, it's you have your portfolio risk. What is your risk when you invest on this? It will tell you either it is a low risk investment, it's a medium risk investment, or it's a high risk investment. So already you know that if I invest in this, what is my risk? Then you will decide whether you want to continue with that as a high risk or as a low risk. Remember, if the lower the risk, the lower the rewards. The higher the risk, the higher the rewards. So it's up to you to decide whether the risk profile is high, which is very aggressive, or it's low, or it's moderate. It will tell you that. And then it will also tell you when it was launched. You don't want to go with an ETF or unit trust which has 6 months. It has no performance. It does not show performance. Remember also that performance of any stock does not guarantee success, that it will also do. But at the same time, what you want to do is you cannot base your investment on something which is new and you don't know how it performs. You don't want to bet on something that you don't want to say the horse that has never won the race will win the race today. And then the other thing it will also show you, which is very important, it's that, as I say, it's a when was this established and the performance. How has it been performing throughout? If it's 10 years, it will show you the performance of the last 10 years. If it's 5 years, it will show you the performance of the last 5 years. And if you see that in the last 5 years, this ETF has been going down and down and down and down, just you buying it will not make it change. And if it was going up, it does not necessarily mean that it will keep on going, but at least you have an assurance that it does perform. There are times when it will not perform, like you remember the 2008 market crash with the .com, that everything went down. So then you'll have, on that, you'll have the fees. If you can look where I have the yellow circles, those are your fees that you pay. And there is for you to calculate that, it's sometimes so much, it takes so much out of you to be able to calculate that. But if you look closely at the unit trust, the unit trust has a a line there that says annual advisor fee, which is very high. It's 1.5, and you don't find it, that 1.5, in your ETF. So immediately it tells you that your ETFs are not as costly as your unit trust, because the unit trust, remember, the unit trust have a unit trust manager who looks after them every now and then, almost like every day. There's somebody who's looking at that and watching the market and making sure that your unit trust perform. And your unit trust, it's on your, you don't have to have, sorry, your ETFs. You cannot have your ETFs in your pension or in your provident fund or your retirement annuity, but you'll have unit trust. So unit trust, the way they are structured to protect the investor more than the ETFs. So those are the, if you look at those, there is a site that I like. Also, they don't pay me. The ETFSA. It has all the ETFs in South Africa that are listed in South Africa, and it will show you their performance throughout, and also it will show you the cost. There is what they call TER, total expense ratio, and if you open up that, it will show you that one ETF, you might have the same ETF from satrix. They have satrix MSCI World. Signia has the same. One Invest has the same. But if you look at their TER, their total expense ratio, they are not the same. One is lower than the other, and that lower expense ratio does not necessarily mean that the other one is better. Look at the top holdings, how it is structured. The top holdings will tell you more about how they are structured. So based on that, then you can decide whether you choose satrix MSCI World, or you choose Signia MSCI World, or you choose One Invest or the other. It just almost the same companies that are in these ETFs, but the managers of different funds have decided to allocate different percentages on those. And the last one of those is when you have now decided on which ETF you want to buy or you want to invest in. Think about where you want to invest. And you remember I spoke about you need to have a brokerage company. You remember I spoke about that guy who told me to have 50,000, to have 100,000 before I start. As I said, today you no longer need that amount of money. There are different platforms, and one of those platforms that I spoke about is Easy Equity. Easy Equity, they don't pay me, so if I speak about Easy Equity, don't think that they pay me. Remember I said also there are others. You have Standard Bank Online, you have Nedbank, you have ABSA, you have PSG, you have 24/7. There are a lot of those brokers that are platforms that you can use. But the one that I said I like, I don't use it. Definitely I don't use it. It's Easy Equity. It's very, very good for people who start to invest. It has, if you have Capitec or Discovery Bank, I think there is a link that you can link with Easy Equity. How you do it, you would find out how you do it, but there is a link that you can be able to link your account so that you just transfer money easy. But it does not mean that if you bank with Nedbank or ABSA or Standard Bank, it has not become easy. Easy Equity has made it easy for each and every bank. You transfer money now, it appears in the next 5 minutes. It's there. But what I also like about Easy Equity is that If it's for the first time that we invest, they have a demo account. The demo account ETFs has 100,000 in it. So it's the money that they say, try it. You try this, you pick up the real ETFs. You can choose the ETFs no matter how many you want to choose. You want to choose 5, you want to choose 10, and then you allocate. If you decide to choose 4, you can probably say, in this 4 that I choose, it's 25,000, 10,000, 15,000. So you allocate the way you want to, or you just divide it by 4, or you divide it by 5. And then you can wait probably for a month or 2 and see how your portfolio performs. Then you can see how your portfolio performs. Then you would know, and it's test driving. When you want to buy a car, they always say you must test drive. The only thing that you don't test drive is a house, but a car you test drive. So test drive before you start. If you already there, you don't have to test drive. If you have done it before, you don't have to test drive, but you can still have that as your imaginary portfolio, that you follow. And after some time, you can see how it performs. Maybe you want to change your portfolio and follow certain ETFs or unit trusts. I have a list that I want to just of my favorite ETFs. When I say my favorite ETFs, it does not mean that you have to use those. The list, I'll just read it out to you. The list it's the top 10 that not in any order. It's not in any order, but those are the ones that I like. It's satrix, MSC World. It's One Invest, S&P 500 IT. There is One Invest Rhodium. It's satrix Resi. Satrix Resi, RESI. It's satrix Resources. And it's Core Share S&P 500. It's Signia MSCI US. It's One Invest Palladium. It's Signia Intrinsic Euro Stock 550, and it's satrix MSCI China, and the last one is Ashburton Global 1200 Equity Fund of Funds ETF. I think they've changed the name, because Ashburton, I think they've changed the name. It's now called FNB Global 1200 Equity. So those are the 10, it's not in any order, the 10 that I like. And I have, if you were to send me a comment or an email to ask me why I like those, I'll be able to tell you why I like some of those. But it does not mean that those are the only ones. There are a lot of them out there that are good. So one of the questions that I was asked is, if I had 50,000 rand to invest, how would I do it? Or if I have 10,000 to invest, how would I do it? If I had 10,000, I would take 10,000 and invest. That's me. Pick up one of some of those, maybe 4 of those ETFs that I've mentioned. Certain ETFs would not appear in your tax-free account because of the high risk that are involved. It's one of them. It's the one that are in resources, your palladium, your rhodium, they would not appear there, or your gold, one gold if it's gold. So the ones that are very high risk, they do not be in your tax-free. But I will pick up 4 of those and split my 10,000 into 4. So it's 2,500, 2,500, 2,500 into 4 in the tax-free. If I had 50,000 to invest, I would immediately take 36,000 rand, put it in my tax-free account, pick up 4 or 5 and invest in them. And the rest will go into my normal ETF account. The reason why I push almost everything into tax-free investment to the max is that, remember, there is no tax. You don't pay tax on that. As your portfolio grows, you don't pay anything. And even if you were to draw money out of that later, you're not going to pay tax on that. So you want to maximize. And you can also, you start using that. We'll also talk about that, how that balances your retirement annuity. We'll talk about that when we talk about retirement annuity. So that would be my advice for the two people that asked me about how would I invest. And the other person asked me about when we're talking about the tax-free, when I said you can use it for education, investment for the children. The question was, would not that if you invest for your children when they are young, by the time they become older, they would want to use their tax-free account. I don't know about the future. Things change so quickly. When tax-free account started, the maximum investment per annum was 30. Now it has changed to 36. So maybe in 10 years' time, it will no longer be 36, and the top will not be 100. It will be maybe 1 million or so, or 2. So we don't know. So you would not be. It is better for you if you help them now for their education, because if you take an endowment, you're going to pay a lot of money. If for taxes, if you just invest it in ordinary ETFs, you'll pay a lot of money for taxes. So it is better to maximize and use your tax-free allowance very effectively. So in the next episode, we'll hone in the last one of this the options that you have, that is the retirement annuity. So remember, if you like the video, click that you like it, and if you want also to be notified when we post another video, just click on the bell, so that when it comes, when we just launch, so when we do another video, it immediately sends you a message. Please also send comments. Those are very important. I can see where we are going, and the questions that you pose there are very important for me when I prepare for the next episode.